Hi everyone. Today we are going to present the audit planning and field work. First of all, we will discuss on pre-plan client's acceptance. What is pre-plan client's acceptance? Pre-plan client's acceptance is the preliminary engagement activities that must be undertaken by auditors shall involve performing procedures. Next, the scope of audit work is engagement letter, fraud and error, and setting audit objectives. Firstly, engagement letter is a letter to clarify the responsibilities and expectation of each party, and to summarize and document this understanding. For example, nature of services to be provided, timing of those services, and auditor's responsibilities. Fraud and error is to safeguarding the company's asset and for preventing and detecting the fraud and error with laws or regulations. It is expected to detect any significant misstatement in the financial statement. Setting audit objectives are associated with the audit of financial statements. The objective is to enable an auditor to express an opinion whether the financial statements are prepared, in all material respects, in accordance with an applicable financial reporting framework. This includes management assertions, transaction-related audit objectives, and balance-related audit objectives. Management assertions. Management assertions are claims made by members of management regarding certain aspects of a business. Management assertions fall into the following three classifications: 1. Transaction level assertion, 2. Account balance assertion, 3. Presentation and disclosure assertion. There are some categories that related to the classification of management assertions, which is accuracy, completeness and occurrence. Next is transaction-related audit objectives. 1. Existence. Recorded transactions exist. 2. Classification. Transactions included in the client's journals are properly classified. 3. Timing. Recorded on the correct dates. Lastly, balanced-related audit objectives. There are some balanced-related audit objectives. 1. Cut-off. Transactions near the balance sheet date are recorded in the proper period. 2. Detail tie-in. Details in the account balance agree with related master file amounts. Foot to the total in the account balance. 3. Realizable value. Assets are included at the amounts estimated to be realized. Next is knowledge of client's business and industry. This includes industry and external environment and business operations and processes. 1. Industry and external environment. There are risks associated to all clients in certain industries. There are a lot of different accounting requirements that the auditor must take into the account in evaluating whether or not to serve a particular client. 2. Business operations and processes. A company tour is one of the steps in getting some familiarity, particularly if questions can be directed to some of the employees. Next, the auditor must strive to understand how the business works. Next, client's business risk. Audit risk is when the auditor gives an inappropriate opinion when the financial statement are misstated. Risks that the auditor delivers an incorrect audit opinion, where an opinion which states that the account presents a true and fair view, meanwhile in reality they don't. Major component of risks are inherent risk, control risk and detection risk. Auditor's business risk. Auditor's exposure to loss or injury from litigation, adverse publicity or other events arising in connection with financial statement audited and reported on. This risk cannot be directly controlled. Preliminary analytical reviews are performed to obtain an understanding of the business and its environment, to help assess the risk of material misstatement in order to determine the nature, timing and extent of audit procedures, is to help the auditor develop the audit strategy and program. Materiality definition. Information that is material if its omission or misstatement could influence the economic decisions of users taken on the basis of the financial statements. Materiality can be referred to as the maximum amount by which the auditor believes the statements could be misstated and still not affect the decisions of reasonable users. Materiality. Fiercely, quantitative, common basis for establishing materiality. 1. Total assets. 2. Total revenue. 3. Net income before tax. Next, qualitative. It is normally selected by auditor for assessing materiality. 1. Fraud or non-compliance with laws or regulations. 2. Small amounts that might violate covenants and contract. 3. Amounts that might affect the trend in earnings. Thank you for your attention.